10-year note yields saw their third consecutive week higher on a Friday as the market continues to sort of nudge those yields higher. They didn't break out. We didn't get above 180. Certainly we got as close as we could without going over in the settle this week, highest going back to the middle of September. And I think right now the market is still in that wait and see mode, still in that range, but certainly has a bias at this point, and that is that yields are likely going to go higher if all goes well next week. We'll talk about that in a sec. At this point, the market's been stuck in that range over the last few weeks at 170 to 180, leaning towards the top, but not able to push through. So at this point, sellers need to come in. Buyers have been around to kind of keep the market balanced, but we have seen a trend of higher yields ever so slightly, and that should continue unless there's an event that changes that. Wonder what that could be. Market volatility. Market volatility is nearing the lows of the summer and will likely hit year-to-date lows on this path if, again, all goes smoothly next week. We have a lot going on, but it tells you that right now the market's not fearful, it's not scared, not concerned, and I think with the idea that the Fed is going to be cutting rates next week and possibly again later this year, that we're going back to the old days of the post-financial crisis when the Fed was just heavily involved and then volatility was at its lows. And that's certainly the path we seem to be on. If you look at other risk assets like equities nearing their all-time highs, you're starting to see kind of a flow of money back into risk, and that's why not? The Fed's going to be there to protect everything. It seems to trade, and getting out of your bonds at these yields and moving into equities where you might be able to catch the wave on the all new highs that they're looking very closely at seems to be the trade. A lot can change though next week, and let's look at what we have next week. Obviously, the headline will be FOMC. We also have the Brexit line in the sand, a changing of the guard at the ECB, and a slew of earnings coming out with Google, Facebook, Apple kind of making the headlines. Others include GM, GE, and ExxonMobil. So you got a whole ton of earnings announcements coming on. Not really sure they're going to take center stage. Really, it's going to be all about the Fed. And the Fed's going to make their announcement on Wednesday. They are expected to cut. There's about a 30-40% odds that they cut again in December. At this point, that could all change on Wednesday. It's really about the forward guidance that the Fed is going to give us. Is there going to be some kind of QE4? Is the Fed going to add to their existing bond purchases? Are they going to look maybe move out the curve again? What are they really going to do? Because if you look at inflation expectations, we got the University of Michigan numbers today, and those 1 and 5 year forward expectations were on their lows, on their near their 5 and near their 10-year lows. So right now, inflation doesn't seem to be an issue, and if growth, which has started to maybe get some whisper talk that it's going to be higher, continues, that's great. But really, the global bodies that be are looking at marking it even lower. We've got still China and U.S. trade up in the air. Brexit, well, it does seem to be coming to some resolution. Doesn't look like a final resolution will happen in the next few days. And I think at this point, the Fed has to be very careful, and they have to walk very, walking on eggshells here, as they don't want to tell the market too much, but they don't want to leave themselves painted in a corner either. So at this point, the Fed will probably keep their language very simple. They will cut rates on Wednesday. They will look to add, if necessary, more cuts down the road, and let the market kind of decide for them. Let the economic data decide for them. And if there is trouble ahead, they have the flexibility then to go ahead and cut more. But again, I see risk assets taking off on this type of news because it means the Fed is back involved and everybody can be happy. And if things start to head south, they will just be there to continue to either buy more assets, or they will be there to cut rates even lower, although they don't have a whole lot of room left. So 10-year note yields creeping up towards 180. Might not see a whole lot of upside there towards 190 or 2%, given the fact that the Fed may come in and look to be a buyer. The Fed may come in and look to help balance things by cutting more and getting along with the other central banks across the globe. But at this point, the trend has been for higher yields. So let's wait and see. It all changes on Wednesday after the Fed meeting.